Welcome to FX Tech's comprehensive USD/JPY analysis for November 17th to 22nd, 2025. This week witnessed extraordinary market action as the pair surged to a 9-month high of 157.88 before Japanese intervention threats triggered a sharp reversal. We'll examine the unprecedented sell Japan trade driven by Japan's fiscal crisis, analyze the paradoxical strength despite Fed rate cut expectations surging to 71%, and provide actionable trading strategies with clear entry points, targets, and risk management guidelines. Our analysis synthesizes insights from 5 major Forex sources: TradingView, Investing Live, Action Forex, Forex.com, and Daily Forex. Let's dive into the critical levels and scenarios that will shape USD/JPY's trajectory in the coming weeks. USD/JPY delivered a dramatic performance this week, surging to 157.88 on November 22nd, the highest level since February 2025, marking a 9-month peak. Despite a late-week pullback triggered by Japanese intervention threats, the pair still posted a solid weekly gain of 1.17%. The trading range was exceptional at 293 pips, reflecting elevated volatility as markets navigated between bullish fiscal crisis dynamics and bearish intervention risks. Technically, the strong bullish candlestick with a significant upper wick signals rejection at resistance, creating a classic reversal warning pattern. However, the long-term bullish trend remains intact, with price now trading decisively above both 13-week and 26-week levels, establishing a structural uptrend that provides a solid foundation for further gains. Japan's fiscal crisis emerged as the dominant narrative driving USD/JPY this week, fueling an unprecedented sell Japan trade. Long-end Japanese government bond yields hit all-time record highs as the bond market signals deep concerns about fiscal sustainability. Prime Minister Takaichi's supplementary budget exceeds 25 trillion yen, with ruling party lawmakers calling for even more bond issuance despite Japan already having the highest debt-to-GDP ratio in the developed world. The most significant development is a fundamental shift in market dynamics. USD/JPY is now strongly correlated with Japanese 10-year yields, not U.S. yields. This correlation shift represents a game changer, as the sell Japan trade provides persistent structural downward pressure on the yen, regardless of U.S. factors, fundamentally altering the traditional interest rate differential narrative. As USD/JPY approached 158.00 on November 22nd, Japanese financial authorities issued a clear verbal intervention warning, and the market listened. The verbal threat alone triggered an immediate sharp reversal, creating the significant upper wick we see on the weekly candle. This demonstrates that 158.00 now represents a critical resistance ceiling where intervention risk is at its highest. The historical context is important. Japanese authorities have demonstrated their willingness to defend the yen despite the underlying fiscal and monetary policy challenges facing Japan. For traders, the implication is clear. Bulls must respect this level and manage risk accordingly. Actual intervention could drive a 300 to 500 pip reversal, with the probability of intervention above 155.00 estimated at 40%. Requiring disciplined position management and appropriate stop-loss placement. This week delivered a paradoxical development that highlights the dominance of Japanese factors over traditional U.S. drivers. December. Fed rate cut probability surged from 30% to 71%, a dramatic 40 percentage point swing, according to the CME FedWatch tool. Normally, such a sharp increase in rate cut expectations would pressure USD/JPY significantly lower by narrowing the interest rate differential. Yet USD/JPY maintained bullish momentum throughout the week, demonstrating that Japanese side factors, the fiscal crisis and intervention risk, have overwhelmed the traditional U.S. rate differential narrative. The first U.S.-driven move came Friday when NY Fed President Williams made dovish comments, triggering a large intraday reversal. Looking ahead, data flow resumption post-shutdown is expected to restore the traditional USD/JPY-US yield relationship. The technical picture presents competing signals that traders must carefully navigate. On the bullish side, we have a decisive breakout from the consolidating triangle pattern, providing technical confirmation for the upward move. The October uptrend line remains intact, and the critical 154.47 level, former resistance turned support, is holding firm. Price remains above key moving averages, confirming the uptrend structure. However, bearish warnings are flashing. A 3-candle evening star topping signal formed Friday, a classic bearish reversal pattern. RSI is breaking its uptrend from early November, suggesting momentum loss, while MACD is curling over toward the signal line. The significant upper wick on the weekly candle shows strong rejection at 157.88 resistance. All 5 major sources confirm the uptrend remains valid, but near-term caution is warranted. Understanding the critical technical levels is essential for effective trading. On the resistance side, 157.77 represents the breakout confirmation level. Daily Forex recommends waiting for a daily close above this level before entering new long positions. The week high of 157.88 provides immediate resistance, while 158.00 is the intervention threat level, where Japanese authorities have demonstrated willingness to act. Major resistance sits at 158.88, with the 161.8% projection target at 160.17 representing the medium-term bullish objective. On the support side, 156.28 marks the 100-hour moving average and first downside target. The most critical near-term support is 154.47, former resistance turned support. A break below this level would significantly dampen the bullish view. Pronounced support at 153.00 and major support at 150.90 represent the bearish invalidation level. For the next 1 to 2 weeks, near-term consolidation between 154.47 and 157.77 is the most likely scenario, assigned a 50% probability as the market digests the intervention threat and awaits critical U.S. data releases. The bullish scenario, with 30% probability, sees a breakout above 157.77 opening the door to 158.00 to 160.17 if the fiscal crisis worsens or data supports the dollar. The bearish scenario, at 20% probability, involves a correction to 153.00 to 155.00 if intervention escalates or the Fed cuts more aggressively than expected. Critical data events this week include U.S. core PCE, the most important Fed inflation gauge, along with preliminary GDP, PPI, and retail sales. Tokyo CPI on Friday could trigger BOJ speculation. Trading strategy: wait for a daily close above 157.77 for new longs, or buy dips to 154.47 to 155.00, while respecting the 158.00 ceiling. Looking 1 to 3 months ahead, the structural bullish bias toward 158.00 to 160.17 remains intact despite intervention risk. The base case, assigned 60% probability, sees a gradual grind higher to the 158.00 to 160.17 range, supported by Japan's fiscal crisis and the interest rate differential. The bull case, at 25% probability, envisions a breakout to 161.94 and beyond if the 158.85 structural resistance is decisively broken. The bear case, with only 15% probability, involves a correction to 150.90 to 153.00 if aggressive intervention, a surprise BOJ hike, or a major risk-off event occurs. The structural support is compelling. A 350 to 400 basis point interest rate differential between U.S. rates at 4.00% and Japanese rates at 0.50 to 1.00% provides approximately 3.5% annual carry. The key catalyst to watch. A break above 158.85 structural resistance would confirm uptrend resumption toward the 2024 high of 161.94. Multiple threats to the bullish thesis require careful monitoring and disciplined risk management. Intervention risk, at 40% probability, tops the list. Actual Japanese intervention could drive a 300 to 500 pip reversal, as verbal threats have already demonstrated immediate impact at the 158.00 level. BOJ policy shift risk, at 25% probability, reflects growing inflation pressures that could force another rate hike, narrowing the rate differential and reducing carry trade appeal. Fed rate cuts, now at 71% probability for December, present ongoing risk as multiple cuts in the first quarter of 2026 would narrow the differential, with each 25 basis point cut potentially pressuring USD JPY 50 to 100 pips lower. Global risk-off events at 30% probability could trigger carry trade unwinds and safe haven yen flows. China-Japan tensions at 20% probability add growth downside risk for Japan, though yen impact remains ambiguous and secondary to other factors. Let's synthesize our analysis into actionable trading guidelines. 5 key takeaways. First, the medium-term bullish trend remains intact despite near-term reversal signals, with Japan's fiscal crisis providing structural support. Second, respect 158.00 as a meaningful resistance ceiling where intervention risk is highest. Consider taking partial profits near this level. Third, exercise entry discipline. Wait for a daily close above 157.77 for new longs, or buy dips to 153.00 to 154.47 for better risk reward. Fourth, target 158.85 initially, 160.17 as the main objective, and 161.94 ultimately if structural resistance breaks. Fifth, implement rigorous risk management. Use stops below 150.90 for medium-term positions or 153.00 for short-term trades, and never risk more than 2% per trade. Reduce position size above 157.00 due to elevated intervention risk. Monitor U.S. core PCE, GDP, retail sales, Tokyo CPI, BOJ communications, equity market levels, and CME Fed watch rate expectations closely.